All right, Evan, let's get in the trenches here. We want to go to banks. So as I was pointing out, we really need banks to go higher for the markets to go higher. We had the XL up more than 4% on Monday. Is the trend now pointing upwards?
Well, let's look at the XLF.
It's like a pregnant pause.
Yeah, it's a loaded question.
Yeah.
Let's look at the XLF, and the XLF has diverged for a long time. The market's been making new highs consistently up until recently. These have diverged for the better part of, since basically the beginning of the year. We've seen sellers in control of financials. That being said, I'm not seeing leadership here. I'm not seeing money flow. I'm gonna bring up Goldman as an example, sort of the industry leader. While we could see a short-term bounce here, to me this is not in an uptrend. You can see a series of lower highs and lower lows. This is something you just want to avoid. And
because I was going to point out too that financials are down 20% for the year, so it wouldn't be surprising if we did see some kind of counter-trend rallies every now and then, right?
Yeah, I think listen, nothing goes straight up and nothing goes straight down. There will be opportunities for short-term traders to nibble on some longs. I know Scott calls them the cute longs or the cute shorts.
Yeah.
There are going to be those short-term pops, and I think we're in the midst of possibly one of those right now in some of the banks.
So then looking at Goldman, then it's up almost 4% on Monday. Then how would you be trading it today? How would you trade that kind of pop?
Well, I think with Goldman, you got to be careful because this is a very time-sensitive, headline-driven type of trade.
Right.
We've seen a nice pop off the lows here from basically the 105, now trading about 116. I think a couple days here of consolidation, a nice sideways, holding this upper range would be healthy, constructive action for another trade higher, but I certainly wouldn't just dive in right here, right now.
Now, for a longer-term investor who doesn't need the short-term trade, at this level, is it finally cheap enough, or do you still want to see that consolidation before you pick away at some longs?
I want to see something change. I want to see the composure change. I'd rather pay up and know that the downtrend is over than try and pick a bottom because it's a very difficult, disastrous trade. You don't want to cost average into a stock that right now is downtrending.
And then speaking about picking a bottom, that leads me to Bank of America. And some people out there are saying that Warren Buffett's investment of Bank of America calls a bottom. Would you agree with that?
I wouldn't go that far. Again, I'm a technician. I try and focus on what the market and the psychology of the market tells me. But I wouldn't go that far. It definitely, the stock caught a lift. We've gone from 6 to basically 8.5. The day the news came out, the reaction from the marketplace wasn't all that constructive. The sellers basically stepped back in. The last 2 days, we've seen a little bit of buying, but this is a very sloppy-looking chart. I think the only thing that's going to make this a healthier trade, a better risk-reward scenario, is time. Give this stock more time.
So you wouldn't be shorting here? Because what was interesting to me is that, it got that pop yesterday on the news that it was selling about 5% of its stake in China Construction Bank, but we already knew that. I mean, yes, they're going to have $3.3 billion in after-tax profit. Awesome. They're going to have more money in their balance sheet, but we knew this was coming down. So I wonder if yesterday was purely a trade or perhaps short covering or something else, so then how would you reverse that today?
I think that with Bank of America, bottom line is I'm avoiding it. I'm not long, I'm not short. My interests are not here until I see something that tells me I need to be here because the risk-reward ratio is, the balance of power shifted to my favor. And right here, right now, with headline-driven and news and on TV every day and in the newspaper, I just don't want to be there.
What about regionals? And I wanted to highlight two, Fifth Third and Regions Financial, just to see if those charts are saying anything different. Because regionals, you could argue, do have better balance sheets, less exposure to mortgages, less exposure to Europe, and they could be a little bit better.
Looking at Fifth Third here, not a picture of strength. You have your 200-day moving average here in black. The stock has been under the 200-day moving average. We saw a real aggressive sell-off when the market imploded in early August. Finding a little bit of constructive price action here, but again, I think it's best left to avoid all the banks. They're just not really where the money flow is.
All right, all the banks avoid. I think that's the strongest recommendation we can get.